guys! In this video, we are going to continue the topic of coronavirus. As we all know, the coronavirus has already turned into a global disaster. It's not only a serious threat to our health, but also to the global economy, which caused the stock market to be in shock. It took Warren Buffett 89 years to experience 5 circuit breakers in the stock market. But we already experienced 4 of them in a month. It sounds crazy, isn't it? But how are the stock indexes calculated, and what does a circuit breaker even mean? Briefly speaking, there are 2 methods to calculate stock indexes. Indexes like Dow Jones or Nikkei 225 are the average price per share of the stock of major industries listed on that index. To find these index prices, you should first calculate the sum of the prices per share of all the stocks included. Then, this sum will be divided by the total number of stocks in the index. The result we get is the value of the index. Indexes like S&P 500 or the Nasdaq pay special attention to the market value instead of only the price per share. To find these index values, we get the market value of a stock by multiplying the price per share by the number of shares of the stock. We add the market value of all the stocks in the index together, and then divide by a certain divisor to get the value of the index. In the American stock market, the circuit breakers happen based on the S&P 500 index. Its function automatically stops trading when prices hit predefined levels per day. If the index falls 7%, trading will pause for 15 minutes. If the index falls 13%, trading will pause for another 15 minutes. If the index falls 20%, the market will close for the rest of the day. Now, you might ask, in a falling market like now, what should the investors do in order to avoid huge losses? Let's look at a commonly used stock term, which is called stop loss. It means you should sell a stock immediately when it falls to a certain price. Stop loss is used to limit the loss and avoid more losses in case the stock falls continuously. When mentioning stop loss, some will say that they won't make any stop losses at all, and instead, just hold the stock and wait for the prices to climb back up to break even sometime in the future. Theoretically, this is totally correct, but is it a rational choice? First, let's look at a simple mathematical problem. John bought a stock with the price of $100 per share. Then the stock fell 10% in value as the market crashed. How much percent must the stock climb up in order to break even again? After falling 10%, the price became $90 per share. We calculate that the price must rise X%, and then we get 90 plus 90x equals 100. Subtract 90 from both sides and get 90x equals 10. Divide both sides by 90 and get x equals 1/9, which is equal to approximately 11.11%. Since the base number for the calculation changed, the stock price must increase by 11.11% to come back to the break even after a 10% cut down. You may say there is no big difference between 10% and 11.11%, but let's look at the following numbers. If a stock loses 20%, then it takes 25% to get back to break even. If a stock loses 40%, then it takes 66.7% to break even. And if a stock loses 60%, then it takes 150% just to break even. The price of a stock can easily fall 50% in a unilaterally falling market. We will use the Boeing company for an example. On March 6th, its stock price was $262. After just 2 weeks, its price fell down to $95. That means that the stock lost more than 63% of its value. If the shareholders didn't make a stop loss, the Boeing stock that they held must rise nearly 180% to get back to the break-even of $262. It may take a very long time, and the shareholders will suffer 2 different aspects of losses. First, their capital will be trapped for a long time. In addition, the capital is locked in a stock with high losses and can't be used to buy other profitable financial products, which results in opportunity loss. Second, the serious defect for a long time will bring great psychological pressure to the investors, which is not healthy. Now, I hope you can see the importance of stop loss and how you can avoid huge losses. Anyway, in a continuously falling market, having cash, observing the market carefully, and waiting for the best chances to buy the really valuable stock is the best choice. I hope everyone makes the correct choice this difficult time. That's all for today. If you have any questions, please leave a comment below or email us at question@beat-math.com. We will try to answer all of your questions in the next video. See you next time!